Everybody just wants to know from Timothy Mood that how long will foreign institutional investors sell? What could be the script of how global markets would move in the light of change of administration in United States? Dollar strength, is it here to stay? And what about India? Well, India was enjoying pedestal positioning. How come it's gone on a back burner? All that and much more in this very special interaction with Timothy Moo. Timothy, must say that as time passes, you still look the same, my friend. Age is catching up for me, but for you, it is just the other way around.
Trust me, it's catching up with all of us, my friend. Maybe it's the light, maybe it's the makeup. I don't have any makeup on, but
so nice
you're too kind.
So nice to have you back. So the question which I want to ask from you is that suddenly it appears that the great Indian bull market, which started in the throes of pandemic, seems to be aging. Is it true that the great Indian bull market is now aged and it has matured?
Well, Deepak, first of all, thanks very much for having me on. It's always a great pleasure. Look, the bull market certainly, by definition, is more mature because it's carried on for a number of years, depending on when you want to measure it. And the market has done fabulously well. One of the best performers over the last decade, even. So clearly it is more mature. That being said, we do not think it's over. I think that's one key message we'd like to convey, because at the end of the day, equity bull markets, the fuel for them is underlying growth, both in the aggregate economy and most importantly, in terms of the corporate earnings. And we think that on a trend basis over the medium term, that there is lots of opportunity for India to continue to grow and for corporates to continue to deliver profits, which in the fullness of time should be reflected in share prices. Now, that being said, we reduced our view in early October of last year. We don't get everything right, but I think we did get the timing of this reasonably right. The market peaked, I believe, on September 26th, and we downgraded, just 1 or 2 weeks after that. The reasons were twofold. One, that the valuation of the market at that time had gotten to 25 times forward earnings, which is high in absolute terms. It was high relative to India's historical trading pattern. It just seemed a lot of the good news was already priced in. And then number two, we had a growing conviction, both at the macroeconomic level and at the corporate earnings level, that there would be what we called a mid-cycle correction, mid-cycle slowdown. And indeed, that seems to be transpiring. We've seen some softness in a variety of high-frequency economic indicators. We've taken our numbers down below consensus, and we've seen weak reporting in the calendar year third quarter, second quarter fiscal 25, and then also we're early in the reporting season for the fourth quarter of calendar 24, third quarter fiscal. And so far, the beats have been outpacing the misses by about 50% to 24%. So, we're sort of still in the throes of this slowdown. We think it still has a bit further to go, but we are looking for opportunities to re-engage because we do have strong underlying fundamental confidence that the growth story can continue. It's in fact one of the best globally, and that is something we want to re-engage in at the appropriate time.
Timothy, you know this more than anyone else, that market and earnings, they don't follow in tandem with each other. Sometimes prices, they go up and then earnings, they catch up. Sometimes earnings, they move forward and prices, they catch up. So at the current juncture, what to your mind markets are pricing in?
So let's put the objective numbers face up on the table. As of yesterday's close, market's off a bit today, but as of yesterday's close, the market was trading at 21.9 times forward price earnings ratio, and that's about one standard deviation above the longer term average. We think actually the market does deserve to trade a bit above its longer term averages. So we're looking at sort of 20, a bit over 20 times earnings as an appropriate point from a valuation standpoint to become more front-footed or immediately constructive. The other point which you asked, which is a good one, is when this slowdown, this mid-cycle correction may be moderating. And it's always hard to precisely gauge this. So I don't want to assume or convey that we've got extra insight on this, but our sense is that we still have a bit further to go in terms of the economy correcting from what clearly was a very high level of activity, kind of above the longer term trend. We're still kind of coming down to that, and earnings we still feel are likely to come in a bit below consensus for the coming year. This year, 2025, our forecast is for 13% earnings growth. Consensus is still 15, so we think there may be still a bit of downward revision to the consensus numbers, and I think we need to grind through a little bit of this, a little bit more, before the appropriate juncture of market valuation and kind of fundamentals and cyclical outlook come into focus and appear to offer a better opportunity to re-engage.
So Timothy, while your call on that earnings slowdown was coming in the month of October was ahead of the curve, great call. But now if you're making a case that somewhere in the midpoint of this year, earnings will recover. So how do you see the challenges which currently are there, they would be addressed?
Well, let me address that in two ways, if I could. I mean, first, just in terms of more immediately, like what do you do with the market? Because just parenthetically, but importantly, I've just been in Europe, and before that, in various parts of Asia. We've had macro conferences in Hong Kong and in London and a variety of other cities, and we actually polled our audiences on outlook for markets and so forth, and had a great number of conversations. So this is a good time for us to be conversing. The point I'm leading up to is that a lot of investors are asking when is the appropriate time to re-engage in India. And our sense is for those who are more sort of short-term, precise timing focused, because maybe the type of money they're running is much more short-term, we think that it may still be a little bit early to come back in. But for those investors who have a much longer-term perspective, maybe a sovereign wealth fund or a family office and so forth, or pension fund, we think that the current pullback in the market is starting to offer opportunities for them, simply because we've seen a 13% reduction in the Nifty from the peak on September 26th, and a 16% in US dollars. So it's getting to be a reasonably notable correction. And the valuation, as I've mentioned, has gone from 25 times earnings down to just a bit under 22. So India is not fully on sale yet. And I'm not suggesting it has to get to be super oversold or cheap, but I think that the current juncture appears to be a better one for longer term money to think about re-engaging. Now, in terms of what will cause all that, I think there's sort of just a natural evolution of things. I mean, the market, or rather the economy, was running quite hot. And typically there are cycles and everything, as I'm sure we're all aware. So it was natural the economy was going to slow somewhat from the torrid pace that it was growing at. We think we're not quite there yet. And if you look at the upcoming budget, which will be announced early next month, the union budget, we think that there will be still a slight degree further fiscal consolidation from what we think will come out to be somewhere between 4.4 to 4.6% of GDP for this current fiscal year. We think that the budget will be about 4.9%. The fiscal deficit will be around that, maybe a touch wider. So the point is, we still think there's a bit more consolidation that we're going through. So the way around, from 4.9% to 4.6%, roughly. So there'll still be a bit more fiscal consolidation taking place, which means that there may be a little bit more slowdown in the economy and pricing of that into the equity market that needs to take place until the market reaches some sort of equilibrium.
Timothy, let's draw your attention to the kind of rampant outflows what we've seen in India. How much of the current outflows in India are cyclical, which is it could be a valuation arbitrage, it could be linked to dollar strength, it could be reallocation to equity for US bonds from equities. How much of that is cyclical and how much of that is structural in nature?
It's always hard to put a precise label on what funds are doing, but from the conversations that we've had with investors and looking at the aggregate quantum of selling that's happened from the peak in September, which is about $19 billion US dollars, which is the second highest on record. But if you compare that against market capitalization, because obviously comparing today's outflows versus those 10 years ago, you need to put that on a sort of a common framework. So it's about 0.4% of market cap that's been sold. The average during various other sell downs, say 10 or so that have more meaningful foreign equity sell downs that have taken place, is about 0.3%. In that regard, it's not sort of excessive. And I would therefore think of it more in terms of labeling it as more of a cyclical outflow as opposed to a structural one. And if I could back that up with one or two points of logic, the first is that all the interactions that we have with investors, there are very few, if any, who seriously question the capability of India to continue to grow at above a 6% real GDP growth rate over the next 5 years, or perhaps even 10 years. And as I was mentioning earlier, there are very few economies or equity markets globally that have that sort of growth rate, other than maybe some much smaller fringe economies where it's easier to grow because at the much earlier stage of development. So I think as far as the a size of an equity market with liquidity and so forth that has that kind of growth profile, India is in a very narrow group, and therefore attracts attention from a structural perspective. So therefore, I would guess that the outflows are largely cyclical in nature, and that has got to do with a couple of things. Number one, the U.S. dollar has been strong. It's up 9% from the lows in September, up 4% in the last month or so. And this is a function in part of developments in the United States, the election of Donald Trump as the current president, and the continuation of this theme of U.S. exceptionalism. And that is sort of attracting a lot of capital globally, and has been fueling a stronger dollar. And it is a very clear, longstanding relationship or pattern in all Asian markets, including India, that when the dollar is strong, equity markets tend not to perform as well. So one of the signals that we would look for, not that we're forecasting a weaker dollar, but if that was to occur, I think that would give a tailwind to both India and other markets in the region more broadly.
Timothy, so 6 months ago, when you had a sell down recommendation on India, that was the same time when China started making a comeback. And the global narrative was that money will move out of India because it was expensive, it will go to China because it is cheap and it is underperformed. But strangely, though China is attractive, it is also getting hit because of outflows. So is the China comeback or long live China trade over?
Well, we have an overweight on China, arguably more from a tactical than a longer-term strategic perspective. But the high-level summary of that argument is that we have full recognition of both the structural macroeconomic challenges that China faces, as well as the near-term topical ones of likely higher tariff imposition under the Trump administration on Chinese imports into the United States. Our baseline view is that there will be a roughly 20 percentage point increase in tariffs on a weighted average basis on China. So there's certainly, we're cognizant of both the near-term and the longer-term challenges. That being said, our job as investors is to understand not only what the fundamentals are, but also how well they are priced into assets. And in China's case, the MSCI China Index is trading at just below 10 times earnings, about 9.8 times forward earnings. For various reasons, even when we bake in a variety of concerns that I just mentioned, we think that 11 times earnings is an appropriate valuation, assuming that there is the kind of fiscal support that we are expecting to help buffer the impact of the likely imposition of tariffs. So the net of that is that we think that China has a good chance to rally roughly 20%, which is a combination of valuation recovery as well as some underlying earnings growth. And that would bring China back to the level that it was just in early October this year, after it had a strong policy driven increase in the market after policy became much more accommodative in late September. So that's sort of our China view. One thing I really would like to emphasize, if I may, is that I understand there's that narrative of, if people sell India, they'll buy China. If they want to buy China, they'll sell India. Not that that's entirely incorrect, but it's definitely not the entire picture. And I want to emphasize that it's not purely an either or situation with India and China. It's perfectly possible, and indeed has happened many times in the past, for both markets to go up, for their own reasons. So it's not only that, foreigners or foreign flows dictate what markets do. And I'll give you two examples, which are both from India and from China, if I may. The first, as you well know, and I'm sure all your viewers know, is that India's market has been propelled, even with the correction last year, it still did very well overall, and was up well over 20% before we started to have that the fourth quarter sell off or sell down. But my point being that it was domestic flows that were really powering the market. Foreigners were modest net sellers for basically all of last year. So this maybe conceit on the part of foreigners that it's only foreign money that dictates whither markets go is patently not correct or not fully correct. And in like manner with China, if we look last year at the flows we can identify for that market, the biggest single flow that we can objectively quantify is the so-called southbound connect flows, which are money coming from mainland China into the Hong Kong Stock Exchange. And that was $106 billion last year, a pretty chunky amount. Well, all the evidence we had was that foreigners were pretty cautious and were generally net sellers last year. So my point being that it was actually in both China and India's case last year that the rallies they enjoyed were driven more by domestic money than by foreign flows. So I just wanted to make sure that point was also communicated.
Thank you very much. So I'll just move to the next leg of our questions, which is that there is dollar strength and there is outperformance in US equity markets. At some point in time, that will either hit a pause or that will reverse. So whenever US markets they hit a pause or whenever dollar strength starts to fade away, do you see emerging markets coming back, or the initial adjustment in US market could lead to further sell-off in emerging markets?
So it's a great question, Deepak. And the concept we have, you think of a chart where this is how the U.S. market performs, and this is sort of how beneficial that is for emerging markets. And the chart you should have in your mind is kind of an inverted smile or a sort of inverted U, by which I mean that if U.S. market is doing really well, then it tends to just attract all the attention to it, and like most investors would say, well, do you really need to bother with emerging markets if I can just make all the money in the U.S.? And indeed, that was the case last year when the U.S. was up, S&P was up 23%, the global market was up 15%, but since the U.S. is now about 70% of the global index, if you take the U.S. out, the rest of the world was up like 5%. And in fact, Asia ex-Japan was up 8%. So Asia underperformed the global index because it underperformed the U.S., but it outperformed the rest of the world by a modest extent. My point here is that when the U.S. does really well, it tends to attract attention to itself. If it sells off to an appreciable degree, then it tends to take other markets down with it. So one of my favorite pet statistics is that in the last 30 years, there have been something like 24, 25 times that the U.S. market has corrected 10% or more. And the Asia ex-Japan index, which is the benchmark for the area that I'm particularly responsible for, was down in every single one of those instances. So there never has been a case where the U.S. market corrected 10% or more, and Asian markets in aggregate did not also go down. However, the sensitivity to the U.S. could vary from just a modest correction to falling a lot more. The point I'm leading up to is that the sweet spot is when the U.S. market just kind of goes into a kind of a range traded mode. And I think the narrative that's supportive of better emerging market performance in that circumstance is that if the U.S. is just sort of trading in a trading range and it's harder to make money there, then investors would feel more emboldened to look for opportunities elsewhere where there might be better growth and cheaper valuations. And of course, if there's a weaker dollar as well, as I was indicating, that is almost invariably been a tailwind for emerging markets. So I think that the summary answer to your question is if the dollar weakens somewhat and the U.S. market sort of goes into a trading range, but not a deep correction, then I think that would be the right circumstances for broader emerging markets to perform better.
Timothy, historically, foreign institutional investors in India, they've always liked three large sectors: IT, financials, and consumer. But they say that when a shakeout happens, the preference also changes. So whenever flows will come back, do you think they would find their way into new themes, new ideas into India, or it could be back to the old ones?
Oh, that's a great question. I'll just it's hard to say, with exact confidence, but I'll offer a couple of thoughts. One is that there seems to be more concern. Certainly, our analysts have voiced more concern about the financials more broadly. We're actually underweight the financials, both the banks and the non-bank financial companies, really because of partly some maybe cyclical domestic liquidity tightening, some issues about some pressure on net interest margins. The fact also that some of the banks were trading had traded up in valuation, et cetera. So, we're somewhat less constructive on the banks for the time being. I don't want to say that's true forever and ever, but for the time being. And I think we've had also a good call there on the part of Rahul Jain, who's our lead financials analyst and head of research domestically. We're more constructive right now on IT and on autos, as well as sort of a collection of other areas for more sector-specific reasons. Some of the internet companies, we like the e-commerce theme. Insurance, we like the real estate theme, and we also like telcos. So we've got a little bit of a kind of eclectic mix, some of them offshore focused, some of them more domestic focused. To your question, I think that investors may come back to stocks and areas in the market that they like. But there also is very much a focus on, what's the new theme? What are the areas that appear to be more attractive on a longer term perspective? We've written extensively in the past year or two about two themes that we like in particular. One is the Make in India theme, which has admittedly done well. We think still, from a fundamental perspective, has farther to go. And this, of course, is wrapped up in the whole broader theme of supply chain shifting from China to other areas in Asia as a consequence of some of the geopolitical tensions, as well as relative cost differentials. And so India, we think, is benefiting from that, particularly as policy is trying to turn more proactive in terms of encouraging manufacturing to come to India. The second one is a theme that we've had great success with collectively. And this is the theme of affluent consumption, or as our analysts put it, affluent India. And the idea is that for the higher income strata, those who are making above $10,000 or more, that cohort's likely to grow significantly in the next 5 years. And their consuming power is growing, and various businesses, both in terms of goods and services, that cater to that consuming power, we think will do well, and that sort of is a play on India's broader, success. So those are not the only themes that we like, but just to enumerate two, we think those are ones that still have further legs to them, and we would expect that foreigners, when they do come back, would be encouraged to look at those themes again.
Timothy, we've also seen this huge emergence of the startup culture in India. The companies which have gone public, from a Zomato to a PB FinTech, we've seen a lot of entrepreneurs are now really taking their business public. What is your way on the way how this entire new breed of entrepreneurs are now emerging? There was a time when India's investment were only concentrated around HDFC Bank and ICICI Bank and Infosys and HUL. But that was 15 years ago. Now it is very different. How do you see this dynamism changing, and how could this affect, future wealth creation?
I mean, in a word, it's enormously exciting that there is this, wealth of entrepreneurial talent, which is encouraged to form all these new companies, not all of which will succeed, but some are clearly succeeding and thriving. And I think this is in part facilitated by the investment in the digital infrastructure that's been made over the past decade or so. The so-called India Stack, which is well known, the biometric identification, Aadhaar, the universal payment interface, ease of opening banks and facilitating transactions electronically and with digital identification. All this has made it much easier to build businesses in the digital domain and scale them more quickly, which I think has accelerated the ability to create new businesses. So a lot is happening. It's accelerating. The news, for example, that Reliance will be building a large server farm is also exciting because it means that India is going to try to keep pace, or at least be a part of the tremendous rapid development in the AI space, around which there's news every day, including last week with China's breakthroughs. So I think net of all this is tremendously exciting and should have a great deal of opportunity. If I could add one other point, it would be that there's certainly last year was a concern on some of the private equity investors that I've had personal contact or conversations with, that there was too much sort of investing capital chasing these opportunities that was driving up valuations and making it hard for the PE players to invest in the disciplined way that they would like to. One perhaps silver lining in the cloud of the market correcting is that perhaps this may be taking some of the heat out of the private market valuations and maybe making or restoring a bit of better equilibrium and order and valuation discipline to the private equity market, which from a long-term perspective is arguably a good thing.
I'll wrap it up with one final question. Let's say if the starting point is today, which is 27th of Jan 2025, if one really takes a 3-year view, which is a reasonable time frame for any fund manager to have, any investor to have, what is the potential on a scale of 1 to 10, Timothy, that from here to next 3 years, Indian markets could give a double-digit CAGR?
Great question. Well, it's obviously better now after the market's corrected 13%. So I feel better about answering the question now than 3 or 4 months ago. Look, if we're back to valuations that are getting close to what we think is reasonable and appropriate, and of course, what is fair value is a question for the ages, but. I would say that if we're back to what we think is a kind of a more reasonable valuation for India's growth prospects, and on a longer term basis, corporate India can deliver, I think, certainly low teens earnings. We've got 13% for calendar year 2025 and 16% for 2026. So call that 14 and a bit. Hopefully, that's a reasonable number. But if the market can deliver that sort of earnings growth and valuations have moderated to more reasonable levels, then being able to print on a 3-year view double-digit CAGR, I think, sounds more reasonable and attainable. So, the answer to your question would be, I think, is yes.
Timothy, really appreciate your time. You've been very accommodative with this interview request, and I certainly look forward to host you in person and perhaps get to know more about the secrets of how to stay young with Timothy Moo.
Thank you. I appreciate all that. I look forward to that special dial you're talking about in Mumbai. Thank you very much.
Thank you very much.
If you like this video, then like, share and subscribe to ET Now.